Today, I'm really happy to have two excellent experts join us. Mark Alexander, who's the Technical Advisory Manager at ANZ, who, if Mark doesn't know something about trade, it doesn't exist. That's how we treat him at ANZ. And we also have Adam Rowe, who's the Executive Director, Head of Trade Finance and Debt Products at Westpac Institutional Bank. So we can't have better pedigree than those two today in the call. Now, I'm going to spend the first few minutes just setting some context, and then I will hand over to our speakers today. You can go to the next slide, please. Thank you. Now, trade finance is not new. Depending upon what history you prefer and what you consider as recorded history. In terms of written recorded history, trade finance instruments as we know them today, for example, a bill of exchange, have been around since the Mesopotamian era, which is close to 3,000 years back. It's a long time. And the fun part is many of those instruments have really not changed that much. So that's quite interesting. And my task today, in the next few minutes, is to explain what the trade finance actually means. And I've been told a few times by people that trade finance is too complicated. It's too pointless to explain. And it is like explaining quantum physics to a cat. Cat doesn't understand quantum physics, and all it wants to know is where the laser pointer is. So I hope I do a better job than that in explaining what trade finance is. Now, it is a financial service which is facilitating the real economy. Real economy here is movement of goods and services which are tangible in nature, which enable companies who are in export or import, but often in domestic markets where you're buying or selling, to monetize your goods or monetize your trade flows, mitigate risk in international when you're trading. That is, whether someone buys, they pay for what they're buying, and help you to settle those trade flows, making payment and receiving payments. That's the simplest explanation I could come up with of what trade finance is. Now, it is significant in the world of trade because without trade finance, there is really no lubricant which enables trade to happen. And it does that by a few things, high-level things, and Mark and Adam will go into some detail here. One is trade finance enables risk mitigation, especially when you're talking about international trade, where you are trading across borders. You may not know who you're trading with that well. You may know them as a partner or supplier, but there may be other risks involved, such as country risk, or in the current more recent cases, risk of geopolitics, or it can even be sorry. Or it can be some unanticipated risk. I don't know how many of you followed this. I followed it with great interest because there was a large container ship a couple of weeks back which had it throttle stuck, and they couldn't really stop the ship, and therefore they had to shut down a port, and that affected a lot of offloading of containers in that particular port and taking new shipments, and created a huge delay in the US ports. Simple things, you can't really predict those things, but trade finance helps you to mitigate those unforeseen circumstances. It provides access to working capital, which Mark and Adam will go through in much more detail. It enables better relationship with suppliers because you are trading with them and you can extend terms if that is what they prefer, or you can go into new markets and increase business if that is useful. That then relates to better competitiveness. So you trade finance instruments allow companies to be much more competitive in the market because that enables them to have more liquidity in their operations. That is more working capital. And that then leads to expansion opportunities. Especially when you go into new markets, trade finance helps you to mitigate risk. Trade finance provides the expertise you need to understand how to transact in a new market. How do you go about it? So those are some basic reasons why trade finance is significant. I will leave you with a number, which is from the Asian Development Bank. There is something called the trade finance gap. Now, trade finance gap is measured as the number of times a business, mostly small, medium type of enterprise type of business, is unable to access trade finance. Therefore, they are unable to really grow their business. And the reason they are unable to access trade finance can be in terms of their inability to understand the risk, their inability to produce the information required for financing, or simply their lack of understanding of what trade financing is. Now, that number is, as of 2023, according to the Asian Development Bank, is $2.9 trillion US dollars. So it is massive. So there is a lot we need to do as a trading community to enable businesses to understand how to traverse the world of international trade and how to access trade finance so that they can grow and protect their business. So with that, I'm going to hand over to Mark, who's going to talk about some common trade finance instruments, and then Adam will go into the detail of how they benefit importers and exporters. Over to you, Mark.
Thank you, Harry. And I'm just going to turn the slide over. Good afternoon, everyone. Thank you for joining from wherever you are. Today, I've been asked to speak in respect of typical instruments that we encounter in international trade. I'll just go on a slide. I'm going to be speaking about three very common transactions that are used in trade finance, namely, as you can see, letters of credit, documentary collections, and bank guarantees. In terms of how they work, why traders use them, and what advantages they might provide, particularly for exporters, and what the difference is between each of these. Firstly, letters of credit, and the parties that are typically involved in a letter of credit, or LC. We have the buyer or the importer. Under an LC scenario, they're known as the applicant because they are the party applying for the letter of credit to be issued. We've got the buyer's bank, referred to as the issuing bank because they will be the bank issuing the LC. Then at the other end, you've got the seller or the exporter, who is the beneficiary of the LC, so named because they will ultimately be the beneficiary of the funds, and a beneficiary's bank, through which the beneficiary would present their documents. I'll show you a transactional flow in a minute, but they may also be referred to as the nominated bank under an LC. So what is an LC? Essentially, it's a method of payment based on an undertaking that is provided by a bank to make payment to the seller, the beneficiary, provided the seller presents the documents that have been called for by the LC and that those documents comply with the LC's terms and conditions. Now, when we talk about documents, we're referring to typical shipping documents such as invoices and packing lists, insurance documents, transport documents, a bill of lading or an airway bill, depending on whether the goods are being shipped by sea or by air, or other miscellaneous documents that could be involved. I'll get on to the life cycle. Looks a little complex, but we'll unwind it for you. This is a typical transactional flow of a site letter of credit. When we say a site letter of credit, that means that the beneficiary or the seller is not providing any credit terms to the buyer, and that the beneficiary is expecting, in effect, immediate payment. And we'll just work through the numbers, and you can see number one right in the middle there, the sales contract, based on the sales contract between the buyer and the seller. it's going to be the applicant over here that will initiate the transaction, and the applicant will approach its bank requesting issuance of the letter of credit. The applicant would typically have a credit facility with its bank, given the bank will be issuing an undertaking on behalf of its client. The issuing bank, number 3, will then issue the letter of credit, and it'll send it or transmit it electronically to the beneficiary's bank. The beneficiary's bank over here, number 4, then forwards or advises details of the LC to the beneficiary. Number 5, after the beneficiary has received and they've reviewed the letter of credit and they're happy with its terms and conditions, it will at that point make a shipment of goods to the applicant. The beneficiary may not, it would be ideal not to make any shipment until the letter of credit has been received, because from the beneficiary or exporter's perspective, the letter of credit represents the buyer's, in effect, willingness and ability to make a payment for the goods, whatever they might be. So after the shipment's been effected, the beneficiary then presents the shipping documents that are called for under the LC, again, invoices, transport documents, and so on. And they'll present the documents to their bank, the beneficiary's bank, and the beneficiary's bank will then examine, they'll check the documents to see if the documents comply with the terms of the LC. For the purpose of today, we're going to assume that the documents do comply. After they've been checked, the bank, the beneficiary's bank, will then forward the documents to the issuing bank, who will likewise check the documents for compliance with the LC terms. Assuming the documents comply, the issuing bank is obligated to make a payment. And you'll see number 8 down the bottom here, the issuing bank makes its payment and then will approach its client, the applicant, and seek reimbursement from the client, and then provide the documents to the applicant, and the applicant's then able to use the documents to arrange clearance of the goods at their end from the shipping company or airline, as the case may be. Once the beneficiary's bank has received the funds from the once the beneficiary's bank has received the funds from the issuing bank, the beneficiary's bank will then just pass on those funds to the beneficiary, and the transaction has been finalised. Again, fairly simplistic. I'll go into a little bit more detail in terms of why the parties would want to become involved in a letter of credit, and there are a number of reasons, particularly why sellers would want to use an LC. As you can see here on this slide, the most important reason is primarily an LC provides surety of payment from a bank. Therefore, the beneficiary, the exporter, can take some comfort in that they're no longer reliant upon the buyer to make the payment. If complying documents are presented to an issuing bank, that bank is obligated to make a payment. The LCs are irrevocable by nature, meaning the terms and conditions of the LC can't be changed or amended unless the beneficiary agrees to the amendment. For example, there's no ability for the buyer, the applicant, to change their mind and seek to cancel the LC. The beneficiary would also need to agree and provide its consent to cancellation or any other change that may be applied for in terms of a change to the conditions of the LC. Notwithstanding any contractual dispute between buyer and seller, and they occur from time to time, an issuing bank is still obligated to pay upon presentation of complying documents, irrespective of any underlying dispute. You can see on the right-hand side, I've just included a set of rules, or a copy of a set of rules one of the advantages of an LC is that LCs will be made or issued subject to these rules, the rules being uniform customs and practice for documentary credits, commonly referred to in the industry as UCP 600. And these rules outline the way in which these LCs are to be handled by all the parties involved. I'll just go over to the next. Oh, sorry, just advanced too far. Okay, moving on to the second transaction type that we see all the time, documentary collections. I'll just go over. These are a fairly simple transaction, less complex than an LC, whereby the shipping documents, the same types of shipping documents that I've mentioned, are presented through the seller's bank to the buyer's bank for ultimate delivery to the buyer, and are an intermediary transaction that sit between a letter of credit and open account. They're also typically subject to a set of ICC rules, in this case, uniform rules for collection, which you can see in the right-hand side of the slide. And a prime reason why a seller would choose a documentary collection is that the seller has the ability to maintain control of the documents and therefore possibly the goods until either a payment is made or an acceptance, a promise, is provided by the buyer to pay at some future agreed date. The role of the banks is pretty limited, and in effect, the seller is using the banking system for, one, dispatch of the documents to ultimately the buyer, and secondly, facilitate the payment back to the seller in accordance with the seller's instructions. Just to illustrate the life cycle of a documentary collection, in this case, it's a transaction initiated by the seller, and the seller would provide the shipping documents together with their instructions for delivery of the documents to the buyer. For example, the seller needs to inform their bank where they're to send the documents, the address of the buyer's bank, and whether the buyer's bank is to deliver the documents to the buyer against payment or acceptance. In this case, the seller, and you can see they're given a name, they're known as the drawer. The drawer, or the exporter, the seller, is going to ship the goods and then present the shipping documents to its bank, which becomes known as the remitting bank, down the bottom of the slide here, which merely forwards the documents to the buyer's bank, which is now known as the presenting bank. The presenting bank then informs the buyer if that the documents have been received, and asks the buyer if they wish to take up the documents. If no credit terms have been provided to the buyer, which means the seller is expecting immediate payment, the buyer's bank, in accordance with instructions provided by the seller's bank, can only release the documents to the buyer once the buyer has paid for the documents. If the parties have agreed that payment is to be made at a future date, for example, 30, 60, 90 days after shipment, then typically the buyer will be requested to accept a bill of exchange, thereby providing a promise to pay down the track, and documents will be released at that point to the buyer. And it's important to note that at this point, the seller is losing control of the documents and therefore the goods potentially. Now, once payment has been effected, whether immediately or at site, immediately at site or at some future point in time, once the funds have been received by the seller's bank will then just on forward the funds to the seller itself. Now, this transaction works a little differently from a letter of credit in that there is no undertaking or guarantee provided by a bank to effect payment. For example, it is possible that the buyer, once they've been contacted by its bank, informing them that a set of documents has arrived, it's possible the buyer refuses to take delivery of the documents, meaning in effect they don't want the goods, which means that the seller has shipped goods and may not be paid, therefore doesn't have the same security of payment as a letter of credit. A documentary collection is generally suitable for smaller value shipments, and not necessarily appropriate in cases where goods can't be on-sold, say, to another buyer. For example, where the goods are perhaps custom-made, a piece of machinery, and built especially for this particular buyer, it's more appropriate that perhaps the parties look to a letter of credit rather than a documentary collection. Just moving on. Bank guarantees. And this is the last transaction type we'll be looking at today. As you can see, the involved parties, we've got an applicant who would request that their bank issue a guarantee on its behalf and would be the party with the underlying contractual obligation. The guarantor is the party that issues the guarantee and may or may not be a bank. And then we've got the beneficiary, which is the party in whose favour the guarantee is to be issued. Unlike letters of credit and collections, which are used to facilitate the payment itself between buyers and sellers, a guarantee is somewhat different in that it's an undertaking provided to a beneficiary, which is issued in support of an applicant's obligation to perform under the contractual agreement it has with its counterparty. And in effect, a guarantee can provide compensation to a beneficiary up to the amount stated in the guarantee in the event the applicant fails to perform. Again, like an LC, a guarantee is irrevocable in that all parties need to agree to any changes to the terms and conditions of the guarantee should they wish to, for example, increase or decrease the amount or extend the expiry date, the validity of the guarantee. A guarantee is also a separate and independent undertaking. That is, a guarantee is independent of the contract between the parties themselves. And ideally, a guarantee would be issued by a bank, given it would have the backing of the bank that issues it and provides surety of payment to a beneficiary if the applicant fails in terms of its obligations under the contract it has with the beneficiary. In Australia, we see a lot of rental guarantees or rental bonds. They're very common and would be issued by a bank on behalf of the applicant, who is the tenant, and issued in favour of the beneficiary, who would be the landlord, and it would be issued in support of the tenant's obligation to pay rent. And if the tenant failed to pay rent on time, then the landlord would be able to, in accordance with the guarantee's terms, make a demand under the guarantee to the bank and claim the amount of unpaid rent, for example. A demand itself is quite simple and could be potentially a single piece of paper which states that the applicant has failed to pay rent and indicating the amount that the beneficiary wishes to claim, up to a maximum of the stated guarantee amount. Guarantees can and are used to cover an applicant's obligations under a variety of scenarios, and we've just put a few together for the purpose of this session. Some of these may be well familiar to you. In the main, they're very common. And the type of guarantee being determined by the underlying obligation of the applicant the guarantee is covering. For example, and we'll just work through these, a bid bond might be issued in a case, for example, where a builder bids for a contract to build a bridge for a state government, and the government awards the contract to the builder. A bid bond would cover the builder's obligation to agree to undertake the contract, and where the builder, say, decided not to do so, the government would incur additional costs in having to put the contract out to tender again. And under the terms of the instrument, would be able to seek compensation from the builder by making its demand under the bid bond. The next one, a performance bond, might be issued to cover, using the same scenario, the builder's obligation to build the bridge in accordance with agreed specifications in terms of the type of bridge, how high and how wide, how many lanes are going to be on the bridge, and so forth. The builder might require an advance payment from the government in order to employ staff and purchase raw materials. In exchange, the government would require the builder to arrange for issuance of what's known as an advance payment bond, which would cover the beneficiary in the event that the builder uses the funds for some other purpose or fails to repay the advance. Now, after having completed the bridge, the builder might be required to issue a warranty bond, which would cover its obligations to maintain the bridge for an agreed period of time. The next one, a customs bond. These are also quite common, and they would cover the obligation of the applicant to pay customs duties for goods being imported or exported. And finally, the payment guarantee could be used in support of open account trade and cover, for instance, a buyer's obligation to pay for goods, or conversely, a supplier's obligations to ship specified goods by an agreed date. All right, so thank you. Today's only very high level in terms of an explanation. If somebody's got some questions at the end of the session, we can address them. What I'll do now is I'm pleased to be able to hand over to Adam, and I'll stop sharing. So, Adam, over to you. Thank you.
I should ensure that I'm unmuted. So I am. Thank you. Thanks, Jacqueline, for handling my slides for me. Thanks, Mark. I've been asked to really just kind of outline in probably a little bit more detail and go into some real life examples of what is actually the benefits of trade finance. I see us using it every day, and as Mark has eloquently outlined, it is used in various ways, particularly within our environment. But really, what are the kind of nuts and bolts benefits for customers, whether they be on the sell side or on the buy side? Jacqueline, if you can push forward, that'd be great. And I think this is what is the value proposition, and I think the sentence that I've outlined there and the subheading is probably really apt for our discussion. Is trade finance seems like it's a very easy everyday requirement to get goods from one place to another, but that simple transaction can come with any. Oops. Okay. Yep. How's that, Jacqueline? So any number of aspects with regards to I'll push forward. Yeah. What we seem to be a simple transaction can have the potential to directly impact what I've outlined there. So what are the impacts in relation to balance sheet? What are the impacts with regards to liquidity? And as Harry outlined at the beginning and Mark made reference to in the specifics, is what are we doing with respect to the effective risk management that trade finance can propose to assist. So I think it's very clear that there are more than just simply getting products from A to B. And as Harry said right at the beginning, trade finance is effectively the genesis of banking. It's probably why people like Mark and I are so enthusiastic about trade, because it really is the nuts and bolts of most aspects of what a bank was actually established to deliver. So if you look at the first aspect with regards to what I see as the value proposition, it's really about improving balance sheet. And what I mean by improving balance sheet, I mean working capital and in supply chain improvements and efficiencies can deliver direct impacts on key balance sheet ratios. So for those companies that have corporate loans and lending and bonds, the improvement that efficiencies in particularly your supply chain and how you use working capital solutions will actually will deliver a direct positive impact to how you can deliver ratios with respect to your compliance and reporting requirements. Solutions can also, I see, effectively leverage idle balance sheet assets to maximize funding capabilities. And what I mean by that is there might be any number of assets that a company might have sitting on its balance sheet: inventory, work in progress, cash in bank, receivables, and working capital and trade finance solutions, as Mark has outlined, and as you move into structured trade solutions, allows you to use those assets, which normally would just sit on a balance sheet. You can use those assets to really supercharge your cash flow. And at the end of the day, we're talking about how do we improve a balance sheet? How do we reduce the strain on a company's working capital and working capital requirements? So the balance sheet has benefits. Then you move into liquidity and how you actually fund your day-to-day operations. And trade finance, as Mark listed, particularly with regards to letters of credit, will help improve liquidity for conducting day-to-day business operations. Will provide the oil to lubricate the trade flow, the trade cycle. It's also a convenient source of funding. It can also, and I'll go further in my next slide, it can bridge the gap between supplier payments and buyer sales or buyer purchases. And also, as Harry also listed in his first introduction, it can also assist in leveraging into different markets. It can look at minimizing country risk. It can look at allowing you to navigate maybe complex or confusing local customs, documentation requirements, regulations, and laws. So I think that will also then see a greater move into different markets, will allow you to increase and maximize your liquidity position. And probably the most important one for practitioners such as Mark and I is that it's an effective risk management solution. As I say there, it really reconciles the interests or the divergent interests of buyers and sellers. And I'll come to that in my next slide. It helps mitigate risks associated with non-payment or default by buyers or sellers. It provides, and really when you start getting into more structured solutions of trade finance, it provides you with the ability to have greater oversight, control, and monitoring of your end-to-end working capital cycle. And which the next point kind of dovetails into that quite nicely, which allows a lot greater access to a wider array of data from a transactional perspective, which allows you to internally have greater control over your audit requirements, but also regulatory requirements, meeting your legal obligations and so forth. So improves balance sheet, improves liquidity, and is a really effective risk management solution. And I think this slide really outlines the solution in its best scenario. Is it the bridging the gap that Harry made reference to at the beginning is really the nuts and bolts of trade finance, the nuts and bolts of banking in many respects. You have a seller on the left-hand side, you have a buyer on the right-hand side, and neither trusts the other to either put the goods on the ship or to pay for the goods when they're either on the ship or when they arrive at a destination. So where does trade finance play? Trade finance plays in the middle of that. It creates the conduit between what is the seller's requirements and what their focus is, and what is the buyer's requirements, wishes, and desires with respect to obtaining those goods. So as I say, that the buyer is worried about paying for goods that won't arrive, or paying for goods that aren't up to spec or are the wrong goods. And obviously the reverse of that, or the reverse of that worry, is that the seller is also worried and concerned that they won't receive payment for goods that they may have shipped. So trade finance is the glue that is in between the requirements of a seller and the requirements of a buyer. And that has been the simple facts and the most simple and the most core benefit for trade finance for many, many years, and will continue to be so as international trade grows. With respect to managing the trade cycle, I always like to refer to an aspect of lengthening the chain. And what I mean by that is looking at what the supply chain is overall. You know, what are the requirements? How many parts of the supply chain do I need to go through to get my goods from A to B? How many other organisations, stakeholders I'm reliant upon to get it from A to B? And what type of trade finance solutions can I use, because they are modular? And what kind of trade finance solutions can I use to get my goods from A to B? So here's just a very simple trade flow, but I think it's a really good example of how many different touch points you may have with respect to a trade cycle, but also, even more importantly, I think it outlines in very good detail how many types of trade finance solutions, trade finance products, but also ancillary products such as insurance or FX and hedging strategies you can use along your trade cycle. So you're going from day 1 to day 240 in this example. And on the bottom of the slide, you've got any number of trade finance solutions. Now, the aspects that Mark went through earlier with respect to transactional trade is really at the front end of that, where I've listed it as trade pre-shipment financing. And then also probably at the back of it, when obviously the goods are delivered and you have an LC that maybe need to be confirmed.
Adam,
yes.
Apologies to interrupt. Jacqueline, I think we need to move a slide. I think. Yes. Yeah. That's
yep. It. Fantastic. Sorry. Thanks, Jacqueline. Sorry. Apologies for that. So I think from that respect, that's the aspect that is probably the best to outline where the products can be touched on a particular level, and where the products can be used in a modular basis to dovetail in between the creditor period, the transit time, stock holding, and also the debtor period. And that can be either domestic, that can be international, that can be domestic and international. So there are many variants with respect to that trade cycle and what can be used in relation to managing your risks, or improving your balance sheet, or improving the liquidity. Jacqueline, if you can move on to the next one. So the benefits, I mean, we can talk about this slide for 2 hours, but you don't really want to listen to me for 2 hours. But I mean, I see some of the benefits from the top around in a clockwise: strengthen supply chain relationships, and I think that's really key, particularly after COVID, or during COVID, and now specifically after COVID. And I'm sure Mark would agree. There's been a fundamental shift with respect to supply chains and how companies are looking at their supply chains. We've moved from supply chain efficiencies, where companies were really looking to get as much efficiency, much streamline out of their supply chains, to now really defending their supply chains, making sure they are still there for them when they need it. Yeah, I make widgets for Mark's Wongle. If I'm not there to make widgets, Mark can't make a Wongle and he can't deliver it to Harry. So there's been a fundamental shift away from trying to extract as much value and streamlining out of supply chains, into making sure the supply chains are robust, strong, and are able to withstand aspects such as a global pandemic. Going around clockwise, managing fraud, risk, and payment default. Obviously, we've just spoken about that. Mark also raised points with regards to how trade manages those types of risks and defaults, and that's fundamental. Most of our interaction with either a sell side customer or a buy side customer will be, how do I manage the risk of a default, or how do I manage the risks associated with a possible fraud or a possible aspect in relation to sanctions or defaults or so forth. So I think that's very fundamental. I think increased collateral and the ability to access increased collateral under your facilities will obviously increase lending capacity. So as I made reference to with regards to balance sheets about being idle, the aspects where you can extract more value out of your balance sheet, more value out of assets such as work in progress or inventory, will then allow you to increase the ability to lend against those assets. Trade finance provides tailored solutions to meet specific supply chain dynamics, and what I mean by that is that there are solutions which are tailored to an agricultural supply chain. There are solutions that can be tailored to an energy supply chain, or a retail, or a logistics, or a manufacturing. Managing counterparty risk is key, and I mean counterparty risk as in managing your buyer or your seller, but also managing their financial institution, and also managing other stakeholders within that supply chain: customs officials, logistics companies, shipping. You can also then tailor recourse elements. I think that's actually a really important one that sometimes gets lost. You're able to, within trade finance, you're able to change the dials on structures to allow you to get to an element of recourse which is comfortable, whether that be complete full recourse, limited recourse, or aspects of a mix. So I think how you can structure your transactions with your counterparties, again, whether they be domestic or international, allows you just to switch the dials a little bit on how your recourse is calculated, and how your recourse is how the rights in relation to recourse are actioned. Just allows you to have a little bit more control over what that supply chain does. And I think, again, one that we've all talked about is trade finance really allows you to navigate the complexities of global trade. Obviously, domestic Australia, between the states, okay, we have different rail gauges, we have different shipping requirements, we have different customs requirements, environmental concerns. Now, if that's only here in Australia, if we then talk about across the Tasman to New Zealand, they're different. If we go north into Indonesia, they're different. If we go further north into China or Hong Kong or Japan, they're different. So regionally, they're different, and then internationally, they're different. So we need to be able to have a trusted partner who can assist you with those complexities and to go through those kind of complexities. Yeah, you may get a great contract in Bangladesh. You may not know anything about Bangladesh, country risk, what the local customs are, what the documentation is. Trade finance and trade finance institutions provide you a trusted partner to help you navigate those complexities with relation to your contracting. Jacqueline, if you want to move it over. Thanks very much. My last slide is really just a really quick case study, just to show you how we've in the past used trade finance to really supercharge a cash flow within an organisation, or we've used trade finance to assist an organisation to actually identify where their problems are within their business. So if we take some key metrics with regards to cash flow, so days sales outstanding, debtor concentration, and payment terms. Now, we all know those concepts. We all know they're very important financial metrics with regards to the economic viability of a company. But when you get those wrong, it can be really damaging to the performance of the company itself, but also the performance of the staff within that company. So if we look at logistics management, I was dealing with a logistics company, a shipping company, with regards to how their performance was just never really getting off the ground. They were struggling. That had been sold a couple of times. There was poor morale within staff. So we used trade finance, and in this instance, we used a structured trade solution to really look at how we can look at maximising the efficiency through better in this instance was better debtor management. And it was really interesting how without even people noticing it or acknowledging it, there were a series of really blatant and obvious mistakes they were doing within their supply chain, and particularly with regards to their trade debtors, that was really harming their business. So, and I've just listed a couple of there. So with regular reporting and with the oversight of trade finance and the trade finance team, you got to points like 14% of invoices were issued that had longer contractual payment terms than actually they thought they had. So 14% of their invoices were not being paid or weren't being issued on 14 days or 30 days. They were being issued on 45 or 50 or 60 days without anybody knowing. So straight away, that was impacting available cash flow. Across the business, there was in excess of 40 different payment terms. So there was again, no one knew who was paying when, how they were paying, or what terms they were paying. A bit of a review through trade finance identified that the largest debtors were also the slowest payers. So you had large debts with large invoice values, and they were the slowest to pay, and no one was identifying that. No one was chasing them. But the debtor book was diversified, so that was a benefit. And they had no knowledge about how diversified their debtor book was or where they should be concentrating on growing. And then then another aspect was, out of that information, we were able to identify, probably a number of top 10 debtors within a huge debtor book that would this a simple allocation of a greater control of the supply chain and trade terms and trade payment obligations could have represented approximately a 20% increase in their available cash. And what I mean by that is that if they had greater management over their debtor book using trade finance, they were able to release up to 20% more within their cash flows that they could reinvest in the company, and they could do more with CapEx and so forth. And also, something I haven't put on the list, but it becomes more of a human relations aspect, is with a better control through trade finance and greater cash release and greater investment, staff morale is obviously going to increase. So I think there are little bits of just how you can play with, again, what I talked about, the dials with respect to concentration limits or payment terms, or what you're doing with your debtor book, or contracting with buyers on a uniformed payment term, not 40. Because with 40 payment terms, how can you expect to manage that efficiently? So I think they're some of the aspects that we feel are what are the kind of real life examples and the real life benefits of what trade finance can provide. Thanks, Harry.
Thanks, Adam and Mark. I think that they're both excellent presentations. There were a few questions in the chat. If you have any more questions, please do put it on the chat, or if you want to ask, please feel free to ask away, and we will try our best to answer that question. While you're contemplating the question, I just thought I'll give you an example to bring to life what are the unexpected pitfalls in international trade and why trade finance helps. And this is what I'm going to talk about as a real example. You can actually Google it. It's a very famous case. Many decades ago, Nigeria, which is a country in Western Africa, I'm sure you all, they found they had oil, and excellent for the country, and they decided we need to extract this resource, export, and bring much needed development and financial foreign exchange into our country, so that we develop our country and help our citizens. Which is great. Which is what anyone would do. They had a couple of issues. One is they needed to build facilities to export that oil. In order to build facility to export oil, you need ports. at that point in time, they didn't really have ports or sophisticated ports. So they issued tenders with the support of various multilateral institutions. They issued a tender global tender for cement, to purchase of cement, so that they can build the ports. And there were lots of companies in the world who were in the business of shipping cement and manufacturing and shipping cement. Said, this is a great opportunity. We have a country which has struck oil and they are going to export oil. Therefore, they'll have money to pay, and it's a good opportunity for us to sell cement. And a lot of these companies participated in the tender, were awarded the tender, and they started sending shiploads of cement. Now, the fundamental problem here was, one of the reasons the country was purchasing cement was they did not have ports. What happened is the ships started coming in, shiploads of cement, and each vessel took a long time. And based on the reports which you see, a few weeks to a few months to discharge the cement from those ships. Now you can then start imagining what happened, because you then had dozens, or if not more, ships lined up waiting to be offloaded of cement. But there's just not enough facilities to offload those shipments because they didn't have ports. Cement and moisture in the air when you're waiting at the harbor, remember we are talking about a few decades ago, do not mix well. So what happens? So all those cements turned into concrete, and the buyer basically of the cement said, we ordered cement, we can't use concrete, which is hardened. So therefore they started canceling the contracts. And why I'm saying this story is the cement exporters who got paid were the exporters who had trade finance instruments. In this particular case, the one which Mark and Adam explained, a documentary credit, where they were able to mitigate this type of risk. The exporters who did not anticipate this type of risk, unfortunately, lost a lot of money. And apparently, there are still many ships which are scuttled across the coast in Nigeria out of that incident. And this is real. I'm not making it up. You can actually go and have a look. So to give you a sense of why trade finance can help you in the most unanticipated circumstances, especially when you are entering into international trade, I just wanted to highlight that example. Now, there is a question on the chat. Is there any banks in Australia, including Westpac and ANZ, which can discount LC USANs? Can you provide contacts? If yes, thank you. Now, the answer to that question is yes. As far as I know, all banks who offer trade finance in Australia also do that. The best way for you to contact them is through the bank's website. Mary, I think I've got your name right. But we can, if you need any help with that, we'll get someone from the Australian Chamber of Commerce and Industry to give you some links. Looks like there's no other questions. Any last final comments from you, Adam or Mark?
Not really, but I would like to thank those that have attended today. It's a good stepping stone. You know, there is a lot to know. I think we all understand that trade should be, and those that have dealt with LCs over the years, it should be a lot easier than what it is. The ICC, the International Chamber of Commerce in Paris, is trying very hard to make it a lot easier for traders through updates to rules and so on, just to provide a simpler interpretation as to the rules. Anyway, thank you.
No, thank you very much.
Thank you, gentlemen. Cheers.
Thanks, everyone, for attending. Like I said at the beginning, this is first of many sessions we would like to have on this topic. If you have any further questions, you want us to delve deeper into any of those topics in trade finance, do reach out to us. You have your contacts at the Australian Chamber of Commerce and Industry. And there's already one topic which was suggested, which is Incoterms. So we will plan that into our sessions. Thank you very much. Have a great rest of the day.